Hi, this is Rob at EminiForecaster.com. I am doing an ongoing series of various technical indicators that people use. One of our subscribers asked me to cover the moving average convergence-divergence indicator, and so that's what I'd like to share with you today. When something has a name that's more syllables than I can count, it usually keys me into the idea it could be a bunch of fluff. Moving averages are great if they're used correctly in technical trading. This is true for one reason. They introduce delay. The amount of delay that a moving average introduces is a function of its length. A 20-period moving average, for example, will introduce 10 periods of delay from the data on which it's based. If you want to track data closely, you'll offset it up to 10 periods, which is half of the length. Then, when you look at it on your chart, it'll track the data very closely. The trade-off for getting this close tracking capability is that the data will then only be current to 10 bars ago. Here we have a graphic complements a trade station. This is a 10-minute chart with a 30-period moving average on it, the light blue line. As you can see, the turning point on the moving average is at the edge of the ellipse. On the left comes 15 bars after the actual price high. On the ellipse on the right, the low on the moving average also comes 15 bars after the actual low in price. On average, a 30-period moving average will introduce 15 periods of delay. So if we offset the moving average by this amount, it will perfectly coincide on average with the turns in the market. Now with the 15-period offset, as we see here, half of the 30-period moving average length, the moving average tracks the data very accurately. This half-wave delay that the moving average introduces is the single most important issue you need to understand when using moving averages in your trading. Will the half-wave moving average always track the data as perfectly as what we see here? No, it won't. This is due to the fact that the length of the moving average does not match the cycle length that is present in the data. This means different base moving average lengths will track the underlying data more accurately at different times. Typically, the moving average length that will track the data most accurately is constantly changing. Keep this in mind as we proceed into our discussion of the moving average convergence-divergence. The base moving average convergence-divergence is, in most charting packages, is made up of two moving averages that are 12-period and 26 periods in length, fixed. Then the computation is to take the difference between the two averages in order to generate what is called a signal line. The signal line is then delayed again by another exponential average of 9 periods. In plain English, then, a single line is the delayed difference between two moving averages, or two delays. Basically then, when the faster moving average, 12 period, is longer than the longer moving average, 26 period, the difference will be positive and will indicate the market is going up. When the faster moving average is below the longer one, then the difference will become negative, indicating the market is declining. To me, it is impossible to be a MACD user because simply looking at a chart would tell me if the market is rising or falling. Looking at a chart also tells me this with no delay. This is particularly important when you add the complexities of having a computation made of two delayed introducing moving averages that are not in sync with the cycle length of the market at all. These complexities can result in the MACD doing some very strange things, particularly in abruptly moving markets. The cycle length is changing or becoming longer than the base 12 and 26 period averages. Let's take a look at an example here. In the graphic, we can see the MACD on the bottom. It has the 12 and 26 period averages in the graph and then the signal line, which is shown as the histogram. As you can see, starting just before midday, the MACD started trending down when the shorter 12-period yellow line crossed below the longer 26-period line. The signal line goes negative at this time while the market continues to go up. Due to the wavelength changes and delays introduced by the moving average components, the MACD is actually inverted from what the market was actually doing. It would take around 26 bars or periods, plus or minus, to correct this. The question is this: is the inversion factor keying us in to an inaccuracy in the MACD? Is there a better trend indicator that did not have these issues? Let's look at a simple trading system optimization grid based on trading the MACD and see how stable it is on its own. For simplicity, I will only optimize the 12 and 26 period lengths and not the MACD delay that is introduced by the 9 period exponential moving average. I will allow the system to simply stop and reverse, always being in the market. Over a testing period of 2 years using the MACD strategy for generating buy and sell signals on the S&P E-mini contracts on a 10-minute chart, the results are very clear. Not one single parameter set was profitable. A much larger test was conducted than is shown in actuality. What this tells us is that doing the exact opposite of the MACD is a better starting point for system development than what conventional wisdom would have us believe. Of course, this will vary according to time. For example, 5-minute, 10-minute daily data. For fun, let's flip the buy and sell signals into their opposite and run our test again. Here we have the results. This is actually pretty amazing. Sorting to the top sets, we see a couple of interesting things. One is the profit is remarkable. 2, many of the best sets optimize to a period of 2 on the short-term moving average. This tells us shorter period average portion of the MACD as well as other delays in the signal line could probably be eliminated. This further discredits the fancy design of the MACD. This is much beyond my expectations of what I thought would happen in these tests. Before getting too excited, we need to ask, is this actually tradable? Unfortunately, it's not. The average trade is only about $15, which is less than the expenses of trading. Ultimately, what this tells us is that we're at the threshold of randomness with our MACD study. Is this to say the MACD has no value? Well, that's up to you. As for me, the next time I want to know if the market's going up or down, I'll look at a chart, because it's much easier to understand what's going on without introducing layers of delays and their inability to track cycling properly. Training one's eye to see things directly from the chart is the best way for me. Could the MACD be used in other ways? Certainly it could, but perhaps a moving average alone could accomplish much the same thing without all the problems introduced by this fancy, verbosely named indicator. Do you use the MACD? Have you been successful at it? Have you changed your mind on MACD viewing this video? What indicators do you use? Would you like me to debunk any other indicators? I'd like to hear from you. Come visit us at EminiForecaster.com/blog page and give us your thoughts. I'd love to review any of your ideas. When we analyze different indicators and how they can be used in trading, it helps us to find biases in the market that can help us to be more profitable. I'd like to thank you for joining me, and I wish you all the best in your trading.